So a super important concept to understand in accounting is how the income statement is structured. So you have revenue, you have fixed expenses and variable expenses, just kind of at a very high level. There are some other categories that could be in there, but at a basic level, that's what exists. Your revenue is obviously what you charge your customers, and the way that you organize that on your income statement should tell you something about your business, something about the different product lines, or that's really what you're trying to do, is gain information from that. And then your variable expenses, I like to think of as a water faucet. So when sales occur, the water faucet turns on and those variable expenses start coming out, or they're also referred to as cost of goods sold. Those are expenses that only occur when you're selling something. And so your revenue minus those expenses, those variable expenses, give you what you often hear of as your gross margin or your gross profit. And then you have your fixed expenses or your overhead that comes out of your gross margin, and that gives you your net profit. That fixed expense bucket is super important to know, because that's where you get your overhead rate from. When you can separate out your variable and your fixed expenses to know your overhead rate, to know your overhead allocation, it can be super helpful with pricing and doing estimates and things like that for customers when you have good historical data to work from.